Welcome to tonight's presentation, or this morning's presentation. I'm Ashley Murphy, founder and principal of Arete Wealth Strategists Australia, a fee-only financial planning firm focused on assisting Australians in America and Americans in Australia. Here is, as you heard me say, there's this wonderful new cover page that we have where I was giving a keynote presentation at the FPA last year. All right, so tonight's presentation, real estate for the expat investor. I'm really trying to tackle this from both sides. So if you're an American in Australia or an Australian in America, there is a bit of a leaning towards the Australian side, but I think you'll find that to be valuable. Okay, of course, this does not constitute personal financial advice. You'd be crazy to make your decisions solely based off the presentation you see here tonight. We provide specialized and personalized advice to our clients. This is simply for education purposes only. Hopefully a little entertainment purposes too. We try and spice this up best we can. All right, so that's me. That was a mugshot a couple of years ago. A little bit about me, as you can see there. No need to read it all. But I love what I do. I love helping people and guiding them through these kinds of decisions. That's why I became a financial planner. I don't know if I ever shared that with you all, but it was back in 2003. I was at the University of Queensland finishing up. I'd come into some money, sadly, through an inheritance, and I went shopping for a financial advisor at the time. And what I found was a bunch of really empty suits and salesmen and people that really didn't know a whole lot more than what I did. Which planted a seed in my head. I thought, surely there's got to be a way to be on the same side of the table as a client, to be qualified in what you're doing, to be acting as a professional and being able to really help people in a way rather than being simply selling to them. And it wasn't until 2008, I went to a UC Berkeley information session. They told me about this type of entity that exists in Australia that didn't exist at the time. They're a registered investment advisor. It's always had a fiduciary obligation to their clients. And I saw the light, the scales fell from my eyes, and I said, right, that's what I'm going to do. And I'm pleased to say that in Australia, the standards of regulation have lifted significantly, and the professional standards for consumers there that financial advisors are now required to give are the best in the world, as rated by Morningstar. All right. What do we help people with? We help them with those issues, as you can see there. Outline of tonight's presentation. So first, we're going to give an update as to where we are in the real estate market, where we've come from, where we are presently, things to consider when buying real estate, but then we break that out to when you're buying it overseas, if you're buying it overseas as an American, and heavens forbid, if you're buying it overseas as an American with a non-citizen spouse. Pros and cons of holding Australian real estate as an American resident. Now, that's not to say as an American citizen. I just mean if you happen to be in America. So in that scenario, you could be an Australian in America. Therefore, you're an American resident at that moment in time. What are the pros and cons of continuing to hold real estate in that scenario? What about the opposite, holding American real estate as an Australian resident? That's what we're looking at tonight. Let's get into it. All right, pros of the what do we have here? Of the Australian real estate market. This is not such an update quite yet, but generally speaking, what have been the pros here? So strong population growth. Now, I had to throw in historically speaking because, as I'm sure many of us know, that's really come to a complete halt. And we had the privilege of learning just the other day that not only do you have to spend 2 weeks in quarantine, but you're having to foot the bill for that. So when we looked into that, my wife and I and 2 kids, we're looking at a $4,750 bill to be held up for 2 weeks. Fair enough. I would say it's only one's obligation if you want to return to Australia after this point in time. Of course, there are exceptions. Not making any judgments. I'm just saying that's the state of things right now. So population growth has slowed way down. Of course, it's also slowed down because it seems as though the passport offices are also MIA. Lack of inventory, that's been an issue in the US and Australia for quite some time. Historically low interest rates. A client was telling me just yesterday that they were seeing interest rates in Australia in the high 1%. It's variable rate, but high 1%, which is enough to make you want to rub your eyes and think you're dreaming. Negative gearing potential for Aussie tax residents. So if you enjoyed that while you're a high income earning Australian, you are not going to enjoy that if you're not an Australian tax resident. Massive infrastructure investment. I've got some great slides coming up, but amongst the data source from which that was taken was one showing that, that there's billions going into Australian infrastructure, which is fantastic. What's not so great in Australia? Low housing affordability. I've showed you that in previous webinars that we've seen Australia, other New Zealand, and Hong Kong, although Hong Kong things are changing there too, was amongst the least affordable in the world. So when affordability gets to that level, I'm always reminded of the situation in Japan in the late 1980s, where things got so unaffordable, they said the 30-year mortgage won't do. We need to introduce the intergenerational 100-year mortgage. And so they did. Of course, that all came to a crashing halt in 1989, and their market index has never recovered its high since that time. So low housing affordability is what we see in Australia. It's particularly unfriendly to non-resident investors. We've got a list of things coming up in a moment, as you'll see. Unfriendly income tax rates, 32.5% from the first dollar. Capital gains taxes, no exemptions for you, my friend, if you're a non-resident. Stamp duty, ghost taxes, all manner of things. The Australian government does not want non-resident investors, or at least wants to clamp down on them somewhat. Transaction volume is likely to plummet in the current environment. Another slide coming up on that, although I don't imagine there's going to be too many hands raised to say that they disagree with that point. So what have we seen? Where have we come from in the past decade? Well, this is what we've had here. So this, you'll see May 2010, what was going on at that time? We were just crawling out of the GFC. We're just coming out of that. So those percentage growth rates were plummeting, deleveraging, foreclosures, we recover, and then get into the teens, the middle years, things are doing very well. We see massive accumulated price appreciation, which I'll show you on the next slide. Things are going well until they weren't as much, but they still weren't negative. Then they picked up again, and then this is about when I have to say I called time on this growth, and we went in reverse. It hit the bottom about mid-2019, but then things began to recover right until now. And I should mention, with the exception of Darwin and Perth, who had their own headwinds to contend with in the form of resources and price declines and other issues going on with major export partners. So we've seen massive price declines there in Darwin and Perth. However, if we look cumulatively this is over a 5-year period. Gosh, I didn't have the end date here, but I can guarantee you this is for a 5-year period of growth. I believe it's up to the end of 2019, even with some softness in the market through 2017 to 2019. These were the cumulative growth figures that we see. So still very positive. I don't want to paint it as a negative picture, because it's not. But let's look at where things have gone. There's been an awful event has fallen upon us in the form of the pandemic. And what we're looking here at is CoreLogic's daily home value index. And what we see here, starting at the end of January, is things were going fine until really mid to late March, and pretty much everywhere. When you can't, when there's a lockdown in effect, it's really not good for real estate. If you can't inspect properties, you can't transact, tenants can't move out, you kind of gum up the system. So we really have seen that around the whole country. Now note that this finishes in mid-May. Please note, because the next slide, we're going to see that continuation. So looking at CoreLogic in some more detail, their daily home value index, we see it's down a whole 0.5% by the 4th of June. So we were at 0.19% by mid-May, and it declined quite a bit more just in a few weeks. We're talking a few weeks, and we're now 6 weeks out from the 4th of June. So I can imagine that things have not improved, let's say, to put it nicely. Or maybe they have. Maybe I'm wrong. Everywhere other than Victoria, I would presume, with their lockdown having recommenced. I haven't looked at this daily tracker. Who knows? It may have picked up in the last couple of days, but that's the trend that we saw from mid-March until the 4th of June. Lending changes. This is what's happened. So loan underwriting and credit, uncertainty. Obviously, there's a lot of people that are very uncertain about their jobs right now, and that has made the lenders a little bit more nervous, hence why the RBA lowered interest rates as they did. Continuity of income, again, being underwritten very strictly. Lenders may vary their application criteria and reduce loan-to-valuation ratio limits. Not good. Expenses are in focus. So as an expat, they'll typically just take 20% off your income to account for foreign exchange fluctuations. So let's say you're making $100,000. Let's say that's great. I know that's US dollars. That's even more valuable when converted back to Australian dollars. They're going to say, we don't care. We're going to say you make $80,000. So that would be instantly reduced there. I'm very excited to share with you, this is fresh out of the Skunk Works, a new development, and that is I'm working on a strategic partnership with a gentleman, a real estate advocate. They don't really have such a thing in the United States, but for Aussies looking to buy property back in Australia, this is a gentleman who offers that service. Will actually find you a property. That's all well and good. A lot of people aren't particularly moved by that. I don't know if I would be, but the real clincher in the deal for me was that he's able to get loan-to-valuation ratios of 85%. That means a 15% down payment to get the most, amongst the most, if not the most, competitive loan package that a non-resident is going to get. So I'm very excited to roll that out to clients. And of course, to clients, that would be free of charge. And to anyone who's not a client, well, I'm afraid that's something you'd have to you look into on your own. US real estate market update. Let's take a look at that. So the Schiller 20 City Home Price Index data is not as current, but year on year to April was pretty good. It was up 4%. Things were also quite positive here. Minneapolis, where I'm coming to you from, was up 6.3% for that period. So price trends that were in place pre-pandemic seem to be undisturbed. I don't believe that for one second. I think that's just because our data is delayed. That's all. The scuttlebutt that I hear on the street from the real estate investment professionals I speak with is they say up until early May, they said actually prices were holding up, and perhaps that's due in part to the strength of the CARES Act and the stimulus that was put into place. An unprecedented amount of stimulus was put into place, but that was really only felt in the mid-market, the lower mid-market, and that's going to vary depending on where you are in the US. But when you start looking at the more expensive properties around, those same real estate professionals are saying, oh yeah, there's really some softness. There's far few bidders, and prices are beginning to ease up a little bit. And we've seen major rent declines. I mean, probably the most dramatic statistic of all comes out of San Francisco, Wall Street Journal, just a few weeks ago, where they were saying there's been a 10% average rent decline just in the past 3 months. So people are getting the heck out of Dodge because they realize, as their employers have said to them, you cannot come into the office. And if you can't come to the office, then why do you have to pay San Francisco rent if you can't participate in all the wonderful features of downtown living? Now, not all of those features of downtown San Francisco living are wonderful, as I can tell you from having lived there for 10 years, but many of them are. Real estate trends, a lot of these are going to be pretty obvious. Non-essential businesses put on hold, thus most real estate transactions have also gone on hold. The first thing that comes to mind for me is a client I'm speaking with tomorrow morning. She moved out of her property, what was it, March of 2019. She decided she wanted to rent somewhere. She still had her house in Oakland. She put a renter in there with a 12-month lease term. Of course, 12 months from it took about a month to settle and move out and everything. So it was April by the time the renter moved in. Now, April 2020, very, very, very difficult to sell your home. It's impossible to have a tenant leave because they can't look anywhere else. It would be inhumane also. So that had to go on hold. And everyone's going to be affected by that. Everywhere that a lockdown is in effect is going to be impacted by that. Mostly the Aussies in the US are in the coastal cities with a sprinkling here and there, and then a sprinkling all over the place of the Aussies married to Americans that could be anywhere, which is kind of my own story and how I find myself here in Minneapolis. But save that for another time. So with all the social distancing rules put in place, it's obviously more difficult. Can't really buy a house if you can't inspect it. Although that's not entirely true. The most enterprising and entrepreneurial of realtors went crazy with their GoPro cameras and took every conceivable shot possible. And so some deals were still consummated nevertheless. This also brings to mind here the massive rate cut to 0%. If anyone's been trying to refinance in the past 6 weeks in particular, you might have found things have really slowed down. And that's a combination of many of these businesses for the first time ever having to work remotely, and with unprecedented volume upon them, we do have to give them a little bit of slack. So it's kind of a perfect storm that they've come into. So what to expect for the remainder of 2020? Well, I'm going to look into my crystal ball. It's a little bit cloudy, but this is what we see here. It all boils down to really the shape of this pandemic and how it plays out. We're just seeing Gavin Newsom just yesterday reinstated a lockdown of certain pubs and bars and gyms and nail salons in California. We saw that happen last week in Texas. So really, we're going to see how this plays out. The US is not dealing with this pandemic very well at all. And I don't think that's a secret. And I don't think there's going to be too many rotten tomatoes being thrown at me for saying that. But that's where we are. So moving on. Real estate as an asset class. So this is broad. Doesn't matter if it was July of 2020 or 2010 or 2000. These are universals that I'm going to mention right here. So pros. So stable inflation-adjusted income is what it's going to provide, assuming that real estate is cash flow positive, which is all too often forgotten by the amateur investor. We'll talk about that. It can be a use asset. Don't misread this later and say it can be a use asset. That doesn't make sense. No, I'm using it in the word that it's something you can use. It's an asset. It's like a car. A car is another kind of bicycle, another kind of use asset. It is something that has value, but you also use it. It can also be an investment asset, as we'll see in my example a little later. Prone to less volatility than stocks and equities. Again, no one disagrees with that because people have got to have somewhere to live. Cons, highly illiquid, i.e. you can't easily sell property. There's high transaction costs in the US. It's amongst the highest in the world at around 6%, about less than half of that in Australia. Ongoing management and maintenance. So these are universals, like I said. Things to consider when, what? Oh my goodness, typo, embarrassing. Let's just take things to consider when considering. My goodness. Things to consider when purchasing real estate. How about that? That makes sense. When purchasing real estate. Okay, I'm embarrassed. That's egg on my face. Okay, rule of 5. This is fantastic. I was in where was I? I was in Crested Butte last week in Colorado on a study trip with some other top financial advisors here in the US, and I couldn't sleep. I don't know why, but I couldn't, and I started watching this YouTube presentation by a Canadian financial advisor, and he talked about this rule of 5. And because my mind wouldn't go to sleep, I looked at it and I was like, yeah, he hasn't really. He's done a great job, and I gave him a thumbs up and positive commentary, but he didn't really go enough for me. And that's yet again why I became a financial planner, because I tend to think about these things. So he has this rule of 5, and it boils down to considering your unrecoverable costs when considering the decision to rent versus buy. So he has this 5% rule. And it looks like this. On the next slide, we'll see it. So we're going to compare two scenarios. If you were to buy a 3-bedroom house, doesn't matter how many bedrooms, it's an irrelevant detail. But in this example, you're paying $5,500 a month in rent, or you could buy the place for $1.25 million. Those are the two choices. Sam Kirkpatrick mentions our transaction costs in the US really higher considering stamp duty in Australia. Well, yes, because we're looking at that line item in isolation, and stamp duty is not a fixed cost and doesn't necessarily apply to everyone in every circumstance. Nevertheless, that is a fair point, and it's worth stating. It gets so complicated to compare between countries, you know, because stamp duty is where the Aussie system will get you with property taxes, whereas in the US, it's an ongoing annual thing, unless you happen to be grandfathered in California through, what was it, Prop 8, Prop 11, I can't remember the number, where the property taxes were frozen back in early 1980s levels. Okay, on to this example for a second. So here's what we're talking about, unrecoverable costs. In the case of renting, it's really simple. It's the cost of your rent, your $5,500 a month, times 12. We get $66,000 for the rent. Plus the renter's insurance, we're going to save $500. So $66,500 in the first year. That's what we're looking at here. Compared with owning, let's take a look. So owning, rule of 5. Let's not forget about that. Property taxes, about 1.3%. That could even be low in certain places. Please see that the numbers that I've used for the owning example are erring on the low side. Even the maintenance costs, as you're about to see. It depends enormously. Is this off the plan? If it was off the plan, newly built, I'd agree, $8,750 would be a lot in your first year of ownership. If, however, it was a used property, then that might not be, especially if you had to redo your driveway or roof, or get a new AC unit or a boiler to keep your home warm in the winter. And by the way, that's less than what the general rule of thumb is. Most people say 1%. So I'm erring on the side of caution for the sake of my example here. Okay, homeowners insurance. I'm a big advocate of good quality insurance. There's nothing like being properly taken care of when you have a loss event. Cost of equity, and I always like to mention there, I'm fee only, so I receive exactly $0 in the way of commissions, fees, incentive trips, President's Cup trips to Cabo, anything of the sort. I don't get a pittance, a dime. I am just a believer in that. I was a former real estate professor, and maybe that's partly why. Cost of equity and debt, we're going to say 3%. Why? Because getting a good mortgage these days is going to be about 3% for a 30-year fixed. Plus, if we consider the opportunity cost of your deposit, let's say you put a 20% deposit down, that's $250,000 in the example that we're about to see. A 3% opportunity cost would be the difference between 3%, what you're paying on the mortgage, versus the 6% gross rate you might achieve on that invested capital. So therefore, it's still 3%. Cost of equity, you see right here. Okay, so this is interesting, what we see here. It's coming in to be about 5%, $65,000. Well, gosh, those figures sure look very similar at face value, don't they? You could rent and pay $66,500 unrecoverable, or you could pay $65,000 unrecoverable. Again, varies year by year because the amount of interest that you pay is going to change given the amortization schedule of a mortgage. Okay, that's not the full picture though. Let's factor in that you must also pay principal when you have a mortgage. In our example here, that's going to throw on $20,878 in that first year, which in turn, of course, you have to pay that. So that's $1,750 more. Now our monthly principal interest payment is a little over $7,000. So we just went from $5,500 to a little over $7,000. That could stretch some people's budgets, and we don't like that. In the CFP exam, I remember studying for that late nights, early mornings back in early 2012. Saw my brother out in Colorado at the time. Thank you, Jeff, for letting me stay with you there. But I remember that one of the statistics that they had you memorize for that, and that was 28%. 28% is the magic number, and they say PITI, it was P-I-T-I, principal, interest, taxes, and insurance should not equal, I don't know where this came from, but it was the, descended from on high. The law of the elders said that you should not exceed 28% principal, interest, tax, and insurance for your housing costs. And so if you went from 5,500 to 7,250, I think is what that number is, or 7,240, that could very well put you into financial distress, especially if a pandemic hits and all of a sudden you're out of a job. Okay, next. Actually, let's not go next. I am going to load my sample. No need to do that separately because I've already got it open here. Here is what they call in the business, this is called an annual property operating data spreadsheet. And this is the spreadsheet that we use on a routine basis with our clients to model these kinds of scenarios. It comes up all the time. I, in fact, did one this morning, did 3 this morning, as a matter of fact, for a client who had a very interesting situation up in Lake Tahoe area. I won't go into that, but let's keep with our example. So you could buy a place for 1.25 million. You've got some purchase costs to get some inspections done. You put your 250 down. There's your total out-of-pocket purchase price. Okay. You can add the realtor commission to your adjusted basis. So there's $75,000. Adjusted basis would mean you are going to get taxed if this is an investment property. If it's residential, you won't. If you live it 2 of the past 5 years in the United States, and 2 of the past 5 years, you'll get single $250,000 capital gains exemption, or $500,000 married filing joint. In Australia, there's no limit to that. If it's your primary residence, they just give you a capital gains free growth on that. So we're going to say that in this particular case, this investor or this resident that became an investor lived in it for 2 years back in 2013-14, and since 2015 has been out. So we have 5 years of depreciation. What's this formula here? This is saying that half of the property, half the value can be depreciated. Why? Because unless there's a nuclear waste that's occurred on that property, which I've never seen before, you cannot depreciate land. You can't depreciate land. Maybe you could also in Cape Cod, perhaps if it's sliding into the water, you could depreciate it. You could say we've got less and less of it, therefore it's worth less. I think it's a fair argument. But mostly, I'm just trying to be funny here and keep it light. You can only depreciate the so-called improvement, the building. 27.5 years is the time frame in Australia. It's a little bit longer than that. In the US, a little bit longer than that in Australia. So it's been depreciating it for 5 years. Therefore, we arrive at that as our adjusted basis. We sell the property in a few years for 1.3 million. We can really use whatever number we want, but in this case, real estate market, that's what it's done over this particular period of time. So 1.3 million. The agent gets paid his or her 6%. We've got some other selling costs to get some things inspected and checked and maybe fixed. So the amount that goes in our seller's pocket is 1.217 million. They made a little bit of money. They paid off their mortgage. Look, that mortgage went from 1 million all the way down to 841. So they've accreted. I love that word. Accreted means accrued and gained equity. They accreted $842,000. Sorry, the inverse of that. So $158,000 just by paying their mortgage. So the equity realized from the sale was 375. So that's the gain in the property plus that mortgage equity accretion we just spoke about, leading to a total gain from the sale, which is 125. So basically everything over the 250 that they put down. They made $125,000, which is not bad. That is equal to a 5.97 internal rate of return over that 7-year holding period. No one's complaining about that too much. Okay, well, let's compare that to the renting alternative. And I'm not here to talk you into or out of real estate. I'm trying to present facts. I'm trying to present a framework for you to make a decision. Okay, and thank you, Russell. I appreciate that. The humor is appreciated. I try my best. Okay, so gross annual rent. We're paying $5,500 a month times 12, 66 grand. We got mortgage interest. Did I pull that from the back of a cardboard box? No, I didn't. I took it right from here, from my loan amortization spreadsheet on the very next sheet. There's 29,714. We're being very conservative. So there's no homeowners association fee. There is, however, property taxes in the US. Vacancy allowance, because even 1 week a year would mean that in lost income. Renovation accrual, For professional investors, anyone worth their salt doing this, they're replacing carpets, they're repainting, they're doing things to make their properties rentable and nice so that they're getting that top dollar. Insurance, like you heard me say before, big believer in that, especially in California. We've got earthquake zones, we've got flooding areas, wildfires, all sorts of things to worry about. That tells you I've been in the US a little bit too long, right? When I use the term wildfire, not bushfire. But I have to say it is a kind of a more accurate term because they're not always bushfires. Okay, repairs and maintenance. There you go. Extra conservative. I used 0.5%, so 6,250 accrued, and annual income. So if we made $66,000 and we had all those expenses, that's what would go in your pocket. Would be 6,250 if you were the investor, if you were the owner of the place renting it to someone else. That's what would go in your pocket. A paltry 0.53% of the property's fair market value. You'd be better off sticking it in a Capital One or Ally high yield savings account, or your yield on equity, which is the money that you've actually put into it, that 250, you're making 1.82. Not too bad. However, this is what I found. Shortly before this presentation began, I thought, you know, I don't think I'm really doing a complete apples to apples comparison, because something occurred to me when I wrote this bottom portion here about we forgot about including the actual principal payment. So what if instead of having to pay that additional principal payment, we use this wonderful formula here, a future value formula, and we said if we could earn 3% on that investment, on that difference of $1,740 a month, which is right there, for 84 months, that's 7 years. If we earn 3% on that, that's $162,000. Well, golly gosh, look at that. Let's compare those numbers. So renting versus buying, we see in this scenario that you actually would have been better off renting when all is said and done, with a lot less headache too. However, that is contingent on that selling price. That's not a whole lot of value. What if we made that 1.35 million? What's the delta on those two numbers? Look at that, disappeared. You would have been better off buying in that particular scenario. This is what leads me, without carrying on all night with my example, this is what leads me. I'm a conservative guy with my clients' money. I hate losing money, and I hate extra losing money on behalf of my clients, which thankfully very rarely happens, but I don't control the markets, financial markets, no one does. But it leads me to be very conservative when a client approaches me and they say, gosh, we really believe in real estate. You know, it's tangible. You can drive around there. You can sit in it. We love it. You can, sniff it. You can, it's physical. We prefer that rather than that stock market that no one understands and no one knows why it goes up or down. So we want to buy. I say, you know what? I understand you. I hear you loud and clear, but I would just say if your holding period is less than really 8 years, and 8 years, I think is a little bit conservative. If it's less than 8 years, then you might think twice about that. And yeah, I think that's a decent rule of thumb. So if your holding period is less than 8 years, I think you increase the probability that in fact in the US I'm referring to, and it's probably very similar in Australia, you probably might be better off renting. Okay, back to it. So things to consider when buying real estate. We're going to stack on this example. So things to consider when buying real estate overseas. Well, there's foreign tax filings, especially if you have any of the pairwise combinations we're talking to tonight, i.e. US and Australia. You're filing taxes every 6 months. There's another tax return to file, another accountant to pay, another more paperwork to worry about. Foreign exchange fluctuation, by gosh, I cover that in almost every presentation. We're not doing that tonight because I thought there was enough content here to keep everyone engaged as it is, but that's been all over the place. We've seen it decline for the past 9 years, the Aussie versus the US dollar, decline for the past 9 years, absolutely plummet in March of this year, and then since then it's recovered since late March, and we're now up to 69.8 is what it was just earlier today. Property management issues, you've got to find someone that will actually collect the rent and fix the problems. Estate planning issues, what do I mean by that? We've now got to be thinking about international wills or trusts, and how and who is this property going to go to? How long is that estate going to take to settle? International wills, of which Australia became a signatory to that model UN convention back in 2015, is actually a pain in the you-know-what. And the reason why is because now, with an international will, your estate has got to pass through probate in one country before it then passes in probate in another country. So if you've ever had a root canal, multiply that by 1,000, and we're now getting to the kind of headache that one form of probate is instead of now two. And you can imagine what's happened to probate in the US in the past couple of months. Changes in law, things are always changing. In fact, just at the beginning of this month, July 2020, we saw the main residence exemption in Australia disappear. Things to consider when buying overseas as an American. Why, as an American, why am I singling out Americans? I'm not really. It's because it's the facts. It's to do with what's called this savings clause that exists in the treaty. What's the savings clause? It says, well, essentially it came into effect. The US won World War II. They get to write the rules. And they said, we agree with this model convention, but if you're an American citizen, and we agree with all the equalizing causes that are here, but if you're an American citizen, none of this applies to you, and we're just going to pretend that US tax laws apply to you no matter where you live in the world. And that's the savings clause. US citizenship-based taxation applies to you. That means we need to figure out whether you have a US tax obligation or not. That doesn't always mean that you have one. I was speaking with a prospective client earlier today, and they fell into this sweet spot where their income was just low enough where the foreign earned income exclusion meant that they didn't have any US tax to pay, but they have to figure it out every year whether they do have to pay. And they were, interestingly, caught up in it regardless, despite the income being below that foreign earned income exclusion, because of, yet again, going back to the, what's that, fifth bullet point in the previous block, the previous paragraph up here, changes in law. 2019, what came into effect? The Secure Act. What's the Secure Act about? Well, it says a lot of things, but the main thing it says is if you inherit a retirement account from someone who is not your spouse and you're not disabled, then you must now take that retirement account distribution over a period of 10 years, which vastly accelerates that and is really inconvenient because most people that are of an inheriting age tend to be in their prime income earning years, which pushes their marginal tax rate up, which means they're paying more to the government than they would have had things stayed the same. They also need, Americans owning property overseas need to file this Form 8938, Statement of Specified Foreign Assets. There's no real problem with doing that other than it's a little bit more paperwork. And if you don't file it, then there could be penalties for that. Now, what if you're buying real estate overseas as an American with a non-citizen spouse? Then you may be unwittingly bringing your spouse into the US tax system. Why? Because now they may have financial reporting obligations that they need to make by virtue of being on the title with you. All right, moving on. Issues facing non-resident real estate owners, whether Aussie citizens or not. So here's essentially everything. If you're owning real estate in Australia and you're not in Australia, this applies to you. Loss of main residence exemption, as you heard me say. Loss of the capital gains taxes, that went away. Exemption, you get a 50% discount on the capital gains for investment property. That went away years ago. And there's a whole slew of other disincentives that state governments have. So higher land taxes, ghost taxes, stamp duty rates, et cetera, et cetera. Okay, pros and cons of holding investment real estate as an American resident. Well, what do we see here? Most of all the typical ones are here, but obviously the loss of the long-term capital gains exemption. You're not paying the local currency, but plenty of cons. And I won't read them out because you can see that right there on your screen. So plenty of cons. But you know what? I found myself in a really difficult situation, and it's cognitive dissonance is the word for this situation. I was listening, you heard me say earlier in the presentation, I'm forming this strategic partnership with a buyer's advocate for real estate in Australia. And I have to say, I was really compelled. This guy, he made a good pitch and he made me think twice. I thought, man, should I really be thinking about buying real estate in Australia after all this time we've been saying all the reasons not to do it? And I came up with a case, and here's my case. So take heed. All right, what if you're buying it as a use asset as opposed to as an investment asset? Meaning you want somewhere to go to back in Australia. You want to be able to unlock that little padlock on that door in that house. It's got all your personal stuff, and you can get your bikes and other fancy equipment that you might have stored that your Airbnb guests don't use. Maybe you plan on moving into the property at some point or using it periodically. That's exactly what I'm thinking is, gosh, if we were back in Australia for a year or even a month or two throughout the year, that could be really handy to have a place if you've ever considered the headache of what would be involved in furnishing an unfurnished apartment or the price of renting a furnished apartment, then that would definitely change your calculus. Might you be able to gear that property to be, and I don't mean gear as in leverage, I mean structure the property to be cash flow neutral, so it's not costing you anything to own it. Might you become an Australian tax resident at some point in the future? Relatively easy to do. If you're a US citizen, you're still a US tax resident because you always are. But if you become an Australian tax resident, then perhaps, and it was your main residence, hey, then maybe there's a way you escape capital gains tax altogether on the US side, and the holding period gets divvied up as far as the Australians are concerned, the ATO is concerned, into the period that it was held as an investment property and the period that was held as a main residence. So you still wouldn't escape the capital gains side on the period within which it was held as an investment, but there would be some relief. Cost of property management, yeah, there's no getting away from that, of course. Pros and cons of holding American investment real estate as an Australian resident. Okay, it's not paid in local currency, can't employ negative gearing. However, I will say that one thing that's not on here is depreciation is more generous in the US. In Australia, they changed the rules recently. You can only depreciate new property, which probably is fairer, right? I mean, why should you be able to depreciate something that's already been fully depreciated just because a new buyer has come along? I don't know. I don't make the rules, but that's what they are in the US. So the new buyer can fully depreciate a secondhand property in the US. That's definitely an advantage to US investment property. And it's important to note, the Australians don't have a worldwide, or I should say, they do have a worldwide system, but they don't have a citizenship-based taxation. So if you're an American in Australia, the Australians aren't taxing you separately from what the US is on investment property. Why? Because property is considered US situs. Situs, Latin for site of. So it's considered a US sourced form of income. Therefore, the US gets the first taxing rights on that. And if there was a difference in tax, I actually don't know. That would be something for an accountant to follow up on to see if you could still end up with an Australian tax bill. I've got to confess those areas that I don't know about because I would never want to say anything I wasn't totally sure about. But so you might still end up with a small Australian tax bill regardless. That really concludes tonight's presentation. You can go over to my website, arete-wa.com. Under media, you'll find my key financial data sheet, the only one that I'm aware of that includes both US and Australian key financial data on the one sheet. It's a two-pager. I am thrilled to say that after many months of promising it, I finally delivered on these white papers. We've got these up, so you can go over to the white paper section and download those. I also want to show you something really cool that is a dream of mine come to life, and that is the GFP Institute, the Global Financial Planning Institute. This is something I've founded. I'm a former professor at UC Berkeley Extension and Golden Gate, teaching financial planning. So what's concerned me, this has got nothing to do with nothing, by the way, this is just a passion project I wanted to share with you. What concerned me, when I landed in the US in 2005, there were exactly 0 books, resources, websites, organizations to help expats, not just from Australia, but from anywhere, figure out the challenges of being a foreign person living in the United States. So given that 15 years later, there's still nothing, I decided to found it myself. And so that's what I've done, is I am launching the Global Financial Planning Institute to train financial advisors on what they need to know in serving expat clients properly. Next, all right, if you wanted to get in contact with me, you feel like I could be of assistance to you and your family's financial situation, please go to the website, click on Get Started, and that is a wrap. I'd be happy to take some questions, and I'll do my best to answer. Let's open the floor on the Q&A. Hey, Jeff, remember it well. I didn't see that in context, but thank you. Robert Bressi, Mr. Bressi, do the effects of the Hart Act further negate the pros of an Aussie expat intending to return to Australia, investing in Australian real estate while living in the US on a green card? Great question. And that is a tricky one. That's kind of one I have to stroke the beard and think about it. I don't think it further adds to it. Because presumably with those funds that you would have otherwise used to invest in real estate, you would have invested in something else. The Hart Act, if anyone's wondering what I'm talking about, please go to, I did a webinar on this, gosh, it was almost a year ago. The Hart Act refers to the exit tax that the US imposes upon citizens relinquishing citizenship, or what are called covered expatriates. Covered expatriates are those that have lived in the US for 8 of the past 15 years and have a global net worth exceeding $2 million. A little bit of background there. Okay, so would it make it worse? No, is the short answer. Christine Blosdale, you know what, Christine? Sam Kirkpatrick here, he wrote to the chat and not to the Q&A, but it was in there beforehand. So just a reminder, please send me the Q&A, not to the chat. But Sam wrote, is there a way to buy an Australian property via an Australian trust set up by a US citizen who is a tax resident of Australia in order to avoid US taxation on that asset? Sam, I love your question. I am looking into that right now. I don't know the answer. I wish I did. I'm hopeful that the answer is yes, but I don't know the answer to that. More than likely, the difference between the systems, the financial regulatory systems between the US and Australia, is essentially principles-based in Australia, rules-based in the US. You get something like this, a question like this, and it makes me think the Aussies are going to be onto it. There's going to be, I'm not optimistic, but that's a great idea, buying it via some kind of trust with an Australian resident trustee. Christine, thank you for joining tonight's presentation. Good to have you here. What on average is the commission for Australian realtors? I know it must be less than American. Well, the research that I did shows between 2.5% to 3%. Or it can be a little over 3% in rural areas where the property purchase amounts are very low. Matt, hi Matt, thank you. I'm a US tax resident and have a number of US rental properties. If I move back to Australia, which would imply that he's Australian, become an Aussie tax resident, how will my rental income and capital gains be treated from an Aussie tax perspective? Fine question. And that's what I alluded to in my last slide there a moment ago. As it's US property, it will certainly be subject to US tax, even if you are no longer a US tax resident. How would you be no longer a US tax resident? If you're a dual citizen, you'll always be a US tax resident. If you're a green card holder, you'll relinquish that green card pretty soon upon arrival, and your presence and your facts and circumstances will dictate you being an actual Australian resident. So that should be pretty clear. And if you're a visa holder, then it will be even clearer than that you are now an Australian resident because you were never a permanent resident of the US. Be that as it may, even if you were or are a visa holder right now, you would still have to pay US taxes on that despite having no other relationship to the US, because that is a US situs asset located in the US. Whether or not, that was the thing that I wanted to say, is whether or not the Aussies would tax you over and above what the Americans have taxed you, I don't know, but I do have a fantastic gentleman who I'm hoping can join me on a webinar next month. I've been dreaming of meeting someone like this. He's an Australian CA, a US CPA, all in the one person with that expertise. It's absolutely fantastic. I hope to do a joint webinar with him, and that would be a crackerjack question to ask him. Any other questions here while we're on the line? Or should we wrap up? Okie dokie. The pace of things is slowing down. Interestingly, somehow the number of attendees is staying the same. So people, I'm guessing, must just love the sound of my voice. I can't see any other. Oh, excuse me. Ian Robinson wrote in. Hi, Ian. Thank you for joining. I plan to return home to Australia to retire in a few years. Wonderful. And currently covered by my US employer's healthcare plan. Do I have to become an Australian tax resident or just a resident before I can get a Medicare cut? Fine question. It is my understanding in that case you have to resume Australian residency. I don't think you can do it from abroad. You might be covered, you probably would be covered by COBRA. Remember, the US has got the most expensive health program in the world, and so it's for that reason a good thing in this regards, because that means that you, by virtue of being on COBRA for that period of time, American health group health plans very, very commonly cover you for international health-related expenses, because the reasoning is can't possibly be more expensive than what it is in the US, and so you're covered there by virtue of that. So I wouldn't worry too much about that one. I'm going to take that as the last question. It has been a pleasure. Please let anyone you know that you feel I can help be aware that that I'm out there and I work with Aussies in America and Americans in Australia. And I will see you next time. Thank you so much.